Hi everyone, welcome to the channel. Please like, please share, and please subscribe. It takes a long time to research, so your support is highly appreciated. If the video stretches out a bit, I will write out the timestamps for each discussion in the video. So let's start off with what is quantitative easing? How does it work? Now, according to the Bank of England's website, quantitative easing is a tool that central banks can use to inject money directly into the economy. Now, according to their YouTube video, let's have a quick view of the video as well. Simply states that new money is generated electronically. So as you can see, what they've just discussed is the money is made electronically, so digitally. They add a few zeros here and there into their magic computer, and what essentially this does is that money is then used to buy assets. Thereas, buy government bonds, buy corporate bonds, etc. Put money
by academic people who've never had sex or run a business. That's
the hope is the money from the retail banks is then passed on to households. For example, we can see here that in the UK, the government bought stake in NatWest Bank, and a portion of this stake was just literally sold last week. You can see it here. I will put the links of each article discussed in the description column. Now, the injection of money. Now, the aim is that it will help the stock market because there's more liquidity, more money, more liquidity. Now, what can this do? This can cause assets to raise in prices or inflate. We're not speaking about inflation as of yet. That will be another video. But we're just speaking generally now, inflation of assets due to the liquidity. Now, this sometimes is called the bubble of everything. We're here on seekingalpha.com. Again, I will put a link of this. If we are to have a look here, it says the real threat is not just the stock market bubble's deflation, but rather blowing up the everything bubble, which means that as I've explained, everything has temporarily been inflated, therefore causing a bubble of everything. So now, to reiterate, because the money has circled within the markets through corporate bonds, government bonds, the hope is that the transmission of the money gets to the people. Now, whenever there seems to be a problem, an economic problem, more money is printed by the central banks and pumped into the markets. However, when more is in circulation, the less valuable the currency becomes. Now, I've just been having a look at Iowa State University's page, and there's an example here. So let's go through the example in order to understand further why the currency becomes of lesser value when more is printed. So let's say the economy is corn, and corn costs $1 a pound. And imagine you all and others earn $100 a month. Each month you buy 100 pounds of corn, exchanging $1 for 1 pound of corn. So the real value is $1 of £1 of corn. So because you're working and everyone's on a fixed amount of 100, corn is 1 for 1. So $1 for £1. Now, suppose the government simply prints more dollar, which basically, and everyone else, it gives you, and that gives you an additional $100. Now, if you want to eat more than £100 of corn a month, now you can do so, amongst others, but the demand for corn in the economy would go up. And very likely the price as well will have to go up, say $1.50 for each pound of corn. Therefore, roughly an inflation on this, and it is, as the professor here puts it, the eroding the value of your dollar, because now you are getting less corn for every dollar that you used to. So I thought that was a good example in understanding the devalue of the currency, or in regards to printing of more money. Now, if we see currently Bitcoin, Bitcoin has been at a record high, housing at a record high, S&P 500, Dow, all have been at record highs, including the Nasdaq as well. So I've got an article here from CNBC where it says, as you can see, this is from the 10th of March, and again I'll put a link to this. So everything has been at a record high. Now, on the 15th of March 2020, the Fed cut their rates to 0 and then launched a $700 billion quantitative easing program. Now, obviously, we understand that this was due to the global illness and businesses were shutting down. So packages were made and loans and etc. were offered in order to help businesses. Some people were working from home. Some people were Netflix and chilling. And during those times, even birth rates were at a record high. I mean, is this due to the Netflix and chill? You decide. But what made the stock markets rise? Now, firstly, it was the lower interest rates. Businesses were offered lower borrowing rates, whereby some governments even offered 0% loans. Similar lower rate loans were also offered to investors. A stimulus package was introduced in order to encourage spending, and the low rates caused low bond yields. But then the next question would be, does the rise of all and everything bubble cause inflation? Will the constant buying of government bonds, money pumping into the markets, cause inflation? That's a great question. Oh, great questions, should I say? But let's address those in our next video. So please subscribe so you don't miss that out. But what we've discussed so far, let's look at the housing market. How is the housing market affected? Now, lower interest rates means lower mortgage rates were on offer. Even in the UK, they introduced a stamp duty tax exemption for properties up to 500,000, and that was again to encourage buying. There we go. The property tax has been suspended on first 500,000 of all sales in England. So yes, it's England, but we can see that everything in the Western world tends to have a domino effect. So what happens in the States then moves on to Europe, and then from Europe to the rest of the world. So again, this was to encourage buying. Coincidentally, if we see here, the UK government has extended this until June of this year, June 2021. But coincidentally, the eviction moratorium in the US is under discussion for further extensions. And those extensions, again, are for June 2021. Again, this is all in talks, but they are deciding if it should be extended until June 2021. Now, the housing market, why have I brought you onto the housing market? Because fewer homes are on the market for sale. So there is less inventory all over the United States and Europe. And well, especially now in Europe, where some countries are in lockdown, so there will be a far fewer. But if we have a look here, we can see the drop. We can see the drop here. Excuse me. We can see the drop from 2008 to 2021, right here. So this clearly shows the inventory. So there's less inventory on the market. So, but in the US, I will put this again, data. So in the US, 11 million tenants and homeowners were significantly overdue as of December 2020. 8.8 million were late on rent and or facing eviction. Now, according to Black Knight's data, 3.6 million of properties are 30 days plus in arrears or in foreclosure. 2.2 million was seriously past due on mortgages, meaning 90 days plus. Now, this is the highest since 2009. And we all know what happened in 2008. As of February 2021, 24% of active forbearance plans are scheduled to end by the end of March. Now, when forbearance ends and new helping measures aren't introduced by the government, then people will be forced to rent, therefore causing an influx on rental demand. Now, Janet Yellen has indicated some help in regards to the renters and helping them with rent. However, she did not specify the help, nor did she specify what the duration of the help is for. However, some have suggested that she indicates helping towards 20% of the rent. But again, this is all hearsay, and I'd like you all to do your own research on this. President Biden has extended his eviction moratorium from January 2021 to the end of March 2021. And again, this is under review for further extension. But actually, did I mention something? Did I mention that the Federal District Court of Texas has declared the CDC eviction order to be unconstitutional? I don't know. This is what they've said, but you decide what's what and what stands. Now, according to Forbes, and this report is from July 2020, more than 40% of US renter households are at risk of eviction, with the company Realty Track currently stating that 50% are above average risk of defaulting on rentals. Again, I will put this link. This is from February 2021. But it should also be noted that these figures and the eviction moratoriums only relates to residential properties and not commercial. So we will have an increase of commercial properties which will be vacant and up for sale, but there's less data on that at the moment, and there's more data available for residential renters and residential properties. Now, what does this all mean? Now, quantitative easing, as explained, helps markets recover in the short term. But as we are in unprecedented times, quantitative easing has been going on for nearly over a year. Stock markets are high, borrowing is high, Bitcoin is high. Even concepts such as NFTs are being sold at ridiculous amounts. House prices are high, birth rates are high. But guess what? Unemployment is high. So if businesses are closing, jobs are closing, and despite what statistics the Fed tells us, inflation is clear to see with our own eyes. I mean, you just have to step outside and see for yourself. But do you know what is alarming? Well, in the words of Jay-Z, men lie, women lie, numbers don't. And from the housing data we have seen, do you not think that history, especially the 2008 housing crash, will not repeat itself? Anyways, thank you for watching. Please support the channel. The next videos I will be doing are going to be on inflation, the gold standard. Are we heading towards a gold standard situation? Will there be a currency reset? And is this everything bubble going to put Europe, put US similar to Japan's lost decade? So I will be making videos on that. Thank you. Take care. Be safe. Be smart. Invest wisely. And save a little for those rainy days. Thank you.